Today, as many of you guys know, there is just a lot of noise out there. There's a lot of changes. There's a lot of things happening in the market that are not what was normal 9 months ago. A lot of talk, fears. And so Churchill does an amazing webinar on a weekly basis. If you want to ever jump on and watch that, we've partnered with them on that webinar, State of Housing. They do a couple different ones facing on, your facts versus your fears and the changes of what's coming and why our market is the way it is. So if you want to be a part of a more detailed conversation in that regard, but today we're going to extract really what buyers need to know and investors about this new market. We are in a new market. We're going to be sharing some new statistics with you and just new market stats that have kind of just like opened up our eyes to how we're negotiating our offers and how that looks different than it did a year ago. So the whole purpose of this is to kind of make it more of like a family room coffee out to coffee date kind of style of just, if you've got questions, feel free to either use the chat or unmute yourself. Don't be shy. I usually like to be in a smaller room with, Mike has a phrase that he always uses, go deeper with few. And I feel like there's a lot of fruit that comes out of spending 45 minutes with fewer people, and we can get deeper with that amount. And then we'll send the recording to those that didn't make it on the call. So with that, I would love to just kind of start to jump in. And if anyone at any point would be willing to come off mute, no pressure, you don't have to, but what are people hearing out there as far as the market? What sounds scary? What changes have happened? What questions do you have? But mostly, like, what are you hearing that's going on out there? And I know maybe you can put that in the chat, or you can kind of come off mute and don't feel like you can't interrupt us. But Mike, you found a list of like the 5 top fears that buyers have right now in this market. Do you remember where that's at?
I do. Let me pull it up real quick. This is interesting, and it's the top fears that exist, and I'm just gonna, so I don't butcher it, I'm just going to read them off. Let me find it real quick. The first one, I remember the first one off the top of my head, and it was specifically on affordability, but it was, are things going to be changing that will affect home prices in the future? So affordability was the first one. The second one was making the wrong decision when it comes to location and having some sort of permanency, but just not being clear on, maybe it's an undesirable location or not up to speed on it. The third one was hidden costs and people being afraid of things that could surface later that are unexpected. Maybe it's property taxes, maybe it's repairs. The next one was lack of flexibility, being tied down to a property. This is really more for first-time buyers. And then the big one is market conditions. Some people are afraid of buying a home during a period of market uncertainty. That's a really, really heavy one. We'll spend some time on that today. But a lot of these things can be overcome with education. That's why we always talk about facts, not feelings. Feelings are a part of being a human being and the emotions that surface with us. But in order to best serve our families and best build wealth through real estate, and what we all believe, best continue to move toward whatever our individual purpose is in life, I think having stability on the home front and making a really wise decision is of utmost importance. So, but those are the fears: affordability, location, hidden expenses, lack of flexibility, and market conditions.
That's awesome. Does anybody have anything they want to add to that? Does anybody hear things out there that you're freaked out about that's not on our list? All right, if not, Mike, can you talk, or Churchill, can you guys talk a little bit about that affordability piece? I know you've got a great slide that goes along with that, and just kind of share with us what we should know about that.
Sure, absolutely. I mean, one of the things that we like to talk about is part of what just being a human being is, we tend to take something that's happened to us in the past and see a pattern and then say, I saw that before, I see that same thing happening now. And so one of the things that's happening right now is we've got a very similar, we have a very similar affordability challenge to what we had back in 2008 and 2009. And the affordability is a big issue right now. And there's a few things that are the same. There's a few things that are very different, but I want to show this slide just for some context, because you can see what's happened since like early 2020 up through, and it's actually come down a little bit from this and then gone back up again. I mean, it's a moving target, and really it's going to be tied to where interest rates are. But you can see that just from a monthly payment standpoint, it's gone up pretty significantly. It's caused some pain in the marketplace. And there's a term called payment shock, which people have if life moves like too fast at once. Our human nature is to just freeze and stop and wait to see what's going to happen. And so from affordability, the cost of homeownership has gone up pretty significantly. And then to the right, there's a chart here, which I kind of like, and it's what's called an affordability index. And you can see that the challenges of affordability right now with where interest rates are even a little more pronounced than it was during 2008. Now, that said, a lot of other things are very, very different. You actually have to go back to the 1980s to see a place where affordability was more pronounced than today. So that's the pain that we're dealing with in the marketplace, is folks trying to figure out what the cost of home ownership, and maybe not even necessarily like understanding how things move over time, but just getting to a place of, number one, can I afford it? Number two, is there changes coming up ahead? Is there a reason to wait? Is it smart to buy? Like, all of these things come up and surface, especially when there's rapid change that takes place. So that's one of the key pain points that we're seeing in the market.
Super helpful. And obviously with that, we bring up the word, what we hear out there is, and, sorry to use this term, buyers, but it's rate breath. It's like the only thing it feels that's the one thing I think gets thrown around so much. And it comes into play that I think buyers, there's a myth out there, and any consumer really. I think I just learned this too. And I've been in real estate for 8 years selling a lot of houses. I didn't realize how much actually went into your rate. So often we throw out, what's today's rate? And it's like, it's not any just one rate. That sure, rates adjust and they change. But we were on a call with Stephen last week and just really focusing on some new loan products and things that we haven't been able to practice with our clients in the last 3 years, and getting caught up on some new things out there. And he pulled up this slide, and Stephen, I'd love for you to share it. It's basically like, I think on the slide, it says the 30 things that determine your rate. And I think Adrian and I were like, 30 things, like there's 30 things, and there's actually more. So if you guys want to like kind of chat about that, because I think this is super helpful to buyers out there to recognize that it's not just a rate, and what can we be learning and maybe adjusting our perspective when it comes to rates. Help us out with that.
Kevin, do you want to give a little overview of this one first?
Sure. And really, this is, I think you hit it on the head. This is what everybody is asking about, right? Is where are interest rates now and where are they going? And a couple of these charts, just for the, the visual, the perspective on the left side, that's 2021 until now. So you can see the first half of that chart, 2021, 3% rates, plus or minus. 2022, we saw rates on a continuous upward trend with inflation rising. And then so far this year, rates have been pretty flat so far. We think the trend is towards, maybe towards downward, coming down later this year. But, the right chart is 50 years of interest rates. So 5, 6, 7%, kind of in context, where it's not a huge high rate long term. But really what's driving interest rates is inflation. So every month we get one of these inflation reports that come out, and the lower those reports are, the more rates are going to come down. The higher those reports are, the more they're going to stay elevated. So this is really a challenge right now for people, right? I mean, part of it's mental, right? Buying a rate with a 6 number in front of it when you're used to 2s, 3s, and 4s is challenging. But part of it is that, and Sarah, I know you'll talk about this next, but especially here in California, we're still in very, very low inventory. There's still enough buyers to hold prices where they are, even if they're, dropping or rising just a little. But then you take a rate and you kind of double your mortgage payment, right? Almost from where it was a couple of years ago. There's a reality there that's scary for a lot of people. So now the big question is, if rates come down again to 4 or 5, in the 4s or the 5s, what's that going to do to home prices? And we think, a ton of buyers will come back into the market and drive up prices again. So this might not be a terrible window to buy in for a lot of people, because yes, the rates are high, but you might be able to negotiate more or get a better price than you would if there were a ton of competition.
Yeah, so Mike mentioned affordability. A lot of it's driven by interest rate. Kevin just talked about the last couple of years, we've seen historically low rates. Now they're creeping up a little bit. When you look back over the last 50 years, we're actually in a good position for interest rates still. So rates are on everybody's minds. You see the headlines. I think that's people that we talk to every day. That's what's on most people's mind is what are the rates? So what we do at Churchill is we spend a lot of time educating and walking through all the questions that people have, first time buyers and even people who've been through the process multiple times. There's a lot of stuff that goes into qualifying for a loan. So like Sarah mentioned, there's so many different things that impact your interest rate, your loan amount, your loan term. Are you purchasing a home? Are you doing a refinance? What's your loan to value? What state are you in? Is it a single family or a condo? So those are just some examples of, what's your credit score is also a big one. Different credit score ranges, you have different interest rate prices. So there's so many different things that go into a rate. A lot of times people call us, they're in escrow on a property and they say, what's your interest rate? And it's not just a blanket answer. That used to be the answer 20 years ago, but with the recent changes in the mortgage industry, it's called loan level pricing adjustments. So there's lots of different variables that impact somebody's rate.
And on this, I'll share something here. It's a little bit sometimes like asking what's the temperature of the United States. And you can get an average, but it really is irrelevant because it depends on what state you're going to be in. And just to give some behind the scenes on this, like imagine all of us on this call, we decided that we were going to pool our money and we were going to loan it out to somebody that was going to buy a house. What would be the things that we would want to know? Well, how's their credit? How much down payment? How long have they been on their job? If this is our money we're loaning, right? Is there, what's the longevity? What's the future potential? Is there other market conditions? Just we saw the list of 30 LLPAs, loan level price adjustments. So the point is this, that all of the loans that get written or underwritten, they end up securitized and put into our mutual funds and our pension plans. So we actually do, all of us on this call own some tiny little piece of all the loans out there if you have any investments in the market at all in your retirement plans. And so that's really what's happening is it's a risk assessment of an individual and of how much down payment and credit. Those are the big ones, income and credit and down payment. Those are, and then 1,000 other little ones that as the last 20 years in the aggregation of data, we've been able to see, oh, this little thing right here can make a difference. And if you have 100,000 loans, the default rate on this is going to be X. So the point is we all own these loans. And because of that, it helps us to understand when you say what's your rate, it depends on, well, those 30 things. So we thought it would be good to show that because a lot of times people think maybe someone has like a better rate. A lot of times when all the information comes to the surface, then you get the true answer. No different than like for Maryland from insurance underwriting. There's a lot of variables to look at. And once you can look at all the variables, then you can get a true answer of what the insurance premium will be. Very similar in the mortgage world. So I like that slide a lot, Sarah.
Me too. And I love that analogy. That's really helpful. I'm going to have to use that one. Got all my Churchill notes here. Okay. Going on to that though, speaking about like, how can we start to use, because that's one thing we're seeing different in how we're equipping buyers, positioning them, leveraging a little bit. We have a little buyer leverage out there. Some people think, oh, is it a buyer's market? We're in a buyer's market. There's a lot of, the supply is sitting around. There's longer days on market. We're not quite, I can't say we're in a buyer's market, but I think we're in a buyer seller market, to be honest. Like when we look at our data, like the little pendulum guy, he's kind of bouncing between the two, depending on kind of the day and the current market stats. And each city will probably be a little bit different. We're going to talk about that in a little bit too. But in that, as we leverage, as buyers have a little more leverage, maybe you guys, can we talk a little bit about how are we equipping our buyers out there to have some financial options here to position, number one, their rate and their affordability and, their monthly payment, and still get the house, because that is happening out there. We have some new ways to negotiate. So Kevin, rate
Sounds
buy-down.
good. I just didn't want to interrupt. Yeah. So like you said, Sarah, I mean, this market has created some interesting opportunities for people, right? Because on the surface, it looks like prices aren't collapsing, interest rates are high. Like, hey, this is a bad time to buy, right? Like that's everybody's instinct. But when you have a little more leverage on the buyer side, which, you just would not have seen in 2020, 2021, when rates were so low and there was so much competition, you can ask for lower prices. You can ask for seller concessions towards your closing costs, or you can use seller concessions to buy down your rate to a lower rate market, whether it's temporarily or permanently. You can almost take advantage of, where rates would be right now by using the seller's money to do it in a lot of cases. So it's not one size fits all, like you said. Sometimes there's still multiple offers. Sometimes it's very competitive. But if we find a property for a buyer where, we have some leverage and maybe it's not as competitive or it's been sitting for 30 or 60 days, we can ask for things that we wouldn't be able to ask for when rates are lower and competition comes back in the market.
Super helpful. On that too, as far as like the local market, what we're seeing is, I find this super interesting because as we dig a little deeper into our market conditions and the stats of that, we, here on the, kind of the 210 corridor here in Southern California where we're located, I'm kind of looking from like our cities of Azusa, Glendora, Laverne, San Dimas, kind of into Upland, and Adri focuses Chino, Ontario, Chino Hills, Rancho. So we've got a good coverage right here. And I would say a year ago, 9 months to a year ago, all of our offers out there were very generalized. It was almost like a template, literally. It was like, it was almost like a template. You had 7 days to do inspections. You didn't have an appraisal contingency. You needed to have what we call an appraisal gap. Like, what can you cover outside of the appraisal? Because this house ain't going to appraise. It's like going for 103% over asking. That was kind of a local average of what a list price to sales price would be. So, Kevin and I were kind of doing some quick math. If it was $1 million purchase, there, on average, it would be at least 30,000 over that ask price. And we saw a lot bigger numbers than that a year ago. And so we're looking at these market stats, and it would be this templated offer. And we would, you'd show 6 houses in a weekend, and you would just be like, you throw something on the wall, see if it sticks. Like, you just start sending offers out. You got to be conventional buyer, 20% or more down, FHA, VA buyers, anybody with any type of assistance program, they just had no chance. And so today it's a lot different out there. But here's what's so interesting. We still have what we consider a supply and demand issue, but we're seeing price reductions. We are seeing those concessions in a different way, not a ton. In fact, our team was on a webinar this morning, and it's a research group that you guys, Churchill, introduced us to, but we watch it every Monday, and they just got off their Zoom at 10 or 11 o'clock. And they were saying that nationwide price reductions have gone down again, which is saying our demand is picking back up. But what's so interesting, let's use Laverne for an example. Laverne is a local town of about 30 to 31,000 people. At least that's what the census says. So don't hold me to that. But it's on average, a year ago in January, on average, the lowest supply was at 13 homes on the market at any one given time. 13. That was at about a 0.8 monthly supply, which means it wouldn't even be a whole month that would go by that would be absorbed, and there would be no more houses on the market if no other houses, listed at that point. Today, and at that point, I mentioned they were getting about 103% of their asking from their list price to their close price. Today, Laverne has 13 homes on the market. They're at 97% of their purchase price, of the close price to their list price. Wow. In December, they were down to 93%. So if you look at that, it's kind of like, what is happening? Well, we still have a supply issue. We're starting to build more demand, but things have slowed down so much that it started to affect the price. But then you move over to Glendora, which is, I think, like 50,000 people in the town, and they're at like 65 homes. They've doubled since last January. So what we're learning is every single city now, it's not generalized. Every city is its own market. It's its own market condition. And if we're not paying attention to what is happening in the neighborhood that you're purchasing, you're missing out as a buyer to leverage. Because as a realtor, what we can do is we go in, not only do we see those price reductions if they happen, let's take Azusa, a local town, back from the beginning of February to today, 9 homes have closed on the market, okay? Out of those 9, 5 had price reductions. 5 had price reductions. 3 had asking price, and 1 was over ask. All of the 4 total that were at ask or above all happened within the first 14 days. Okay. Everybody else, the other 5 that lost some of their leverage in their price was after those first 2 weeks on the market. And what we found is when we went in and we dug deeper, we found not only did they have anywhere from a $10,000 to $15,000 price reduction, they also had about a $10,000 to $15,000 concession. That's a total of $20,000 to $30,000 from the seller. The story to me, Kevin, I don't know, correct me if I'm wrong, Churchill, that's probably a buy down. That's probably a rate buy down. If we're seeing that average, would you kind of agree to that? It's something to do with the financing.
Yeah, credit from a seller towards your closing costs, one way or the other, however you use it, is about a 3-to-1 benefit to the buyer as like dropping the price. So $10K in closing costs, like if you just applied it to the rate, all else equal would be like a $30K drop in price. So a lot of buyers are getting to the point where they're saying, hey, payment is what matters, right? Like I'll pay what it's worth. It's going to appraise. Like you said, we're not having the same appraisal issues, but I need my payment lower. So you and me like might work together to help a buyer and say, hey, look, we can ask for 30 grand less in price. We might not get the house, or we can ask for 10K in closing costs and use it towards your rate. That's where a lot of buyers are going. So I would bet, most, if not all of those buyers that are getting credits are using it to help with their payment.
Yeah. One of the examples we had recently, we were putting an offer for our clients in the city of Corona, and the comparative sale that was like the model match of the home looked way nicer on pictures, right? Everything looks nicer on pictures. But it was listed at the same price as the one we were putting an offer on that's been on the market like 180 days, mind you. So we were like really doing a low ball offer on this one property, but I felt like we need to know what's going on this property, the comparative sale one. Okay. And we'll call it, was on like Fairview or something. That was the good comp, but it was a pending comp. So you don't see what it's pending for. Mm-hmm. In our trained minds, because we're still trying to adjust from 9 months ago. Yeah. If it went pending overnight, I would think that it would be at asking price, right? Or above. Mm-hmm. It was 2 weeks on the market, so it wasn't overnight. So I call the agent and I'm like, can you share at all what's going on this property? I'm writing an offer on a comp over here. And she just spilled the beans, which they don't usually. So I was like super lucky, but it was a really interesting conversation because she got 6 offers over the weekend. It had sat for 2 weeks. Not one of the 6 was at asking price. They were all below. And so they ended up accepting an offer that got her to net just below the asking price. But she told me, she's like, it's going to show that it went over ask, but check the concessions. We did a buy down on that. So number one, what I want buyers on this call to hear is this is the fun part of being on a buyer only like seminar, because, and if you are a seller that has to sell, don't lose hope. We have great news for you, but that'll be another class. That's my shameless plug. But buyers, you determine the value of homes. No one else gets to determine the value of this market, of these homes. Buyers get to determine that. And we are seeing that more than ever right now. And we got to see it 9 months ago when buyers were determining the value of 120,000 over ask, right? But the same is true in this market. And so out of 6 buyers on one sale, not one of them came over ask. But you know what she said? All of them, all 6 were within $5,000 of each other. That should tell you something. And they were all 15,000 under ask, which I find super interesting because it's not like they're just like, ooh, 3,000 less or 10. I mean, it's a substantial reduction, a substantial, under ask, but they were all within this same category. So buyers, we get to go out and we get to play hardball right now and get to have a voice in the market that we haven't had. One thing, Adri's VA certified on our team and helping the veterans out there. And what are you seeing, Adri, on the MLS as far as VA and FHA goes?
So I went through the recently sold in Chino this morning, and of the 25 that I went through, that about 22% were FHA VA. So that is nowhere near last year's numbers. That's a lot more. It was really hard to get any VA or FHA offers accepted last year because of the appraisal gap that was so strong last year. Everyone was including those in their offers, and they don't have the ability to do that on FHA or VA loans. So with that having gone away, they can now be competitive.
Mm-hmm. That's hopeful. And that's something to think about too, as we go into a season. I know California doesn't have many seasons, Sarah, over there in Alabama. Like you're worrying about tornadoes, and we're just complaining because it's 40 degrees outside, which is freezing, by the way. But we do have a real estate season that's coming up, and that's school getting out. We pick up pretty strong in March, April, May, because people want to buy into school districts locally. And so I really believe there are two factors that we're going to look at. We have a lot of buyers coming back into the market who stand a chance, the FHA and the VA. FHA and VA can come in with 0 down. FHA comes in with their low down payment. They have some benefits to their financing terms that they get to utilize in this market. And then with the rate buy down and all the added things, people are going to start to adjust to this and get used to it. So I think we're going to get a lot of those buyers back. But I also think a lot of people went into rentals last year because they had to. They couldn't get into that purchase. And I believe that we're going to have a lot of people that really are seeking home ownership, but they were put in a position, their own, a conditional need to have to get into a home, are going to have to come back into the market, and they're really seeking to build their own net worth instead of paying someone else's mortgage. And so I do think we're going to, as that webinar was showing today, we're going to start seeing more demand come up. I think back to when gas prices, first went up, and we still had to drive our cars. Who stopped driving their car because gas prices? I mean, you might have pushed more of your errands together on one day so you weren't wasting gas, but we've all adjusted. I don't think any one of us started riding. Maybe some people started riding their bikes. Good for you. But people are going to adjust to this. So with that though, Churchill, where do we think this is going to go as far as rates? Or, I mean, that's what they're waiting for a crash, or waiting for all the deals to come up. How can we adjust to this so we don't miss out? Because I do think there's an opportunity here.
Yeah, there is, looking at market cycles, we're at the bottom of 2 different cycles right now. One of them is the economic cycle. The other one is a seasonal cycle. And the big question for where real estate is going to go is a lot of people, in fact, this is kind of what I was saying as we were just starting this call, but a lot of people saw a run up in real estate and then a crash in 07, 08, and 09. And they saw a run up in real estate now and say, guess what? I've seen this movie before. We're going to have a crash. And what most people don't realize is that the fundamentals, the under the surface, is very, very, very different than 2007 and 8 and 9. Dramatically different on the supply side and on the demand side. And if you ever want to understand, I think if for all of us, what are we trying to do? We're trying to make smart decisions that will be in the best interest of our family and our wealth building efforts, right? And do things that are going to be safe and smart. And one of the challenges that we have is we spend a lot of time on the education to show what's the same and what's different. And it really is a little bit of a crystal ball. If you want to understand where values are going to be in the future, there's a couple things that you have to look at. And one of them is affordability. And affordability is more of a ceiling than a floor, right? So what it's going to do is affordability will slow the growth for a certain pool of buyers. But if you look at all of the folks that buy real estate, out of 100 buyers, 27%, 27 out of 100 are cash buyers. 33 out of 100 are first-time buyers and have some affordability challenges. And then the difference, what is that? 40. Those are buyers that don't have affordability issues, and they've got maybe sizable down payment, but they are holding back right now to see what's going to happen, right? And so there's a lot of pent-up demand, because when we look at the basics of supply and demand, we have not enough homes to meet the population and the population growth. there's just not enough homes, and it's going to take years to build enough homes. And so that's something that's not getting talked about in the media at all, is because it doesn't really sell. But when we look at the under the surface and the fundamentals, there is a wave of new buyers coming in. There's more buyers than homes available, and there's an undersupply of homes right now. And I don't remember which slides we have, but we can walk through some of the visuals on that. But we actually see this right now as a really good time for a buyer, especially a first-time buyer that has plans to be in real estate for 2 to 3 years or longer, to buy a house and get a massive amount of seller concessions, because this will go away later in the year for a few reasons. One is when interest rates start to come down, and they will for a series of reasons, there will be more demand, because there's a lot of psychology involved with people that say, I don't really want to buy because the rate has a 6 in front of it, and I just don't think that's a good deal. What they don't realize is that there's of 100, there's 10 more people that are saying the same thing. And when rates touch the 5, guess what's going to happen all at once? It's like trying to go shopping on, that Black Friday or Thursday or whatever it is. I never shop, so I don't even know what it is. Black Friday, is that what it is? One of those. Like, who wants to go when everyone else is going, right? I want to go Wednesday late at night when no one else is there. I can go get my stuff and go to the checkout and get out and don't have to see anybody. So that's what we have right now. But again, most people don't know, and they just think that maybe there's a crash coming, and they don't understand some of the concession strategies. Like, there's one strategy we use a lot. It's called rate relief, but it's like a stair-step strategy where, let's say interest rates are 6.5. The first year they can have a 4.5 rate. The second year it'll be 5.5, and then the third year it'll be 6.5. But guess what? We'll be able to refinance them somewhere in there, because rates will be coming down, at least all the things that we see. And so from an affordability standpoint, somebody can get in with a much lower payment. Maybe we do have a slide on that. So yeah, Sarah, I look at this market as like a once in a generation, because there's a wave of buyers coming, and it's going to take a lot of time to build up the demand, or to build up the supply to meet it. Yeah, here's a great example. Kevin, you want to talk through this one?
Yeah, this is exactly what Mike was saying, right? This is 700 to 20% down, so kind of round numbers, but check out the first 2 columns there. That's year 1 and year 2 for this specific buyer, instead of just jumping straight into that payment in year 3. The only downside of this program, the seller has to, pay for the savings for the first 2 years. So this was a $13,000 seller concession in this case, but the upside of this market, it's not impossible. It's not impossible by any means to ask for that in a lot of cases. So it's case by case whether it works or not. But this is a really cool strategy, because you almost you get the benefits for the first couple of years at least of a lower rate environment, but you don't have to compete against all the buyers that would come into the market if that were to happen overnight, let's say.
I think another factor to think about too with seller motivation is, unfortunately, if sellers are joining the market right now, they missed the market. Like, they missed their peak, and they're trying to play catch up with that. And that's the narrative we're hearing from a lot of sellers. It's like, oh man, we should have probably listed like last May, right? And you're like, well, don't look backwards. Let's keep going, because there's still good things out there and they still have a lot of equity. But as a buyer looking into those seller situations, a lot of sellers are still leaving the state. We still have a lot of sellers that are trying to get out. And the whole reason one of the many reasons, but a big reason we weren't seeing a lot of supply last year was because where are they going to go? They couldn't even get into a property, right? A lot of people wanted to move to Arizona. You couldn't buy a house in the whole entire state of Arizona unless you were like a hut in the middle of the field, like the desert, because honestly, they wouldn't take a contingent sale. It was like an absolute no in the state because of their supply and demand issues that are nationwide. But what we're seeing is sellers now, their motivation is almost higher than it was 9 months ago, but they've just missed out a little bit on timing, but they still have a lot of equity. And so no matter what, they're willing to have the conversation. And I think we're in this little sliver of a moment where we get to slide our way right in there and utilize our leverage, because they're still trying to adjust from last last summer. And unfortunately, a lot of agents aren't leading and guiding their clients, and they're setting them up just to fail. And then they get exhausted and they languish on the market, and they're losing control every day on the market. And so as we get to kind of like slide right in there like a slithery snake, we can take advantage of that. Not that we're like trying to take advantage of people, but it's unfortunate. That's how it works. And you're going to go in and you're going to have some leverage there. If you're on this call and you have a property to sell, though, what I would tell you and help guide you in the conversation, whether it's here in California or out of state, Sarah, this is for you, like as a new agent in Alabama, like setting yourself up to succeed in your listing comes from upfront inspections. Get those inspections done on your property that the buyer is going to do on your home. If you can tell the buyer what's up, you just took care about 90% of any headache that's going on in that conversation. Make sure that buyer is cross-qualified with a lender that you trust, because a lot of these homes that do fall out of escrow have to do with financing. A lot of these buyers, because the rate's so volatile and it's bouncing all over the place, and all 30 of those factors, things change. And so all of a sudden they go to get into escrow and they go to do a full underwriting, because not everybody's like Churchill. They don't do it up front, and you accept an offer, and within 10, 15, 21 days of their loan contingency, they back out because they actually don't qualify for your house anymore. So make sure that you do the legwork, make sure that your property is ready to go. I'm not saying do all these crazy repair. I mean, if repairs need to be done, but like position yourself to win. There's 4 things that are going to help you sell your home. And this, these are the 4 things we negotiate towards as buyers, but it's condition, exposure, price, and the agent. And so price is big too. Position yourself to win. Appraisers are now shifting their adjustments on their appraisals. They're looking more at the weight of what's active than what has been a closed comp. That's interesting to me, because the active sales are probably lower than the closed comps, depending where we are in the market and what city we're in. And so they're actually looking forward. So look forward in what you're looking at. And as a buyer out there too, we have to look forward. We have to look at the active comps. Usually we never look at active, we look at closed, right? It's what it closed for. But now we're looking somewhat at the active. Those active listings do hold weight. So it's all about positioning. I think one thing, Churchill, that maybe if there's any other, shameless plug here, it's how can we get our buyers ready for when they are ready to purchase? Because it's not something, you're better off being over prepared and proactive than reactive in this market as well, because there's some smart moves we can make, but we can't make them if we're not ready. So speak to that. How can we make sure everybody's got the right shoes on?
Sure. One of the things that is interesting to know is that cash buyers typically get about 3% to 4% better deal than those that are not cash buyers. And because of that, one of the things that we do is we will upfront underwrite every single client so that when they make an offer, the heavy lifting on the loan is already done and all they need is a property. And that allows them to be able to make an offer without any of the stress that comes from a loan, because it's done upfront. It's called an upfront underwrite. And so usually we're able to, secure, maybe it's not as good as a pure cash buyer, but it's certainly better than somebody that has to go through the loan. And I do a lot of fix and flip projects. And so I'm looking at this from the perspective of a seller. If I have an offer that comes in on a property of mine and it's a cash buyer, versus I still have to wait and see if there's a loan contingency, and I have to wait 17 days. And, to Sarah's point, maybe the property. But if I can know with certainty that the loan part is done, I feel way more confident accepting that offer than others, even if the price is maybe a little bit lower, because the peace of mind for me is worth something. Right? The peace of mind is worth it because I want to have that transaction closed and move on. So there's a couple of things, and Kev, maybe you can talk through this, but we have a strategy to get offers accepted that this cash buyer equivalent is one of those talking points.
toss something in real quick before Kevin says that. As Adrian and I as we do our local research, we are seeing cash buyers coming back into the market more than we have in the most recent past. Cash buyers hardly could compete when it was so crazy. They were going to throw an extra $120,000 at the end of the day more, right? So they've been kind of in the background, but we have started to see a lot more cash buyers in this market. So anyway, to your point, go ahead, Kevin.
Yep, and just to piggyback on what Mike said, I mean, the upfront underwrite is key, and then the key is communicating that as well to the other side, right? Where, you know, Sarah or Adrian and I will get together when an offer goes out, and instead of just doing the full approval upfront and giving them a letter, you know, we'll call or send a video to the listing agent and tell them exactly what, you know, where we are in the process, so they can communicate to their seller and say, hey, look, this isn't just a normal pre-qual. This offer is a little bit different. This one's fully underwritten. They're good to go with the underwriter, all that kind of stuff. So we found, like, over the years, like, the full upfront underwrite is great, but it's really only worth a whole lot negotiating wise if the other party, the selling side, understands it as well. So we're really intentional about communicating that.
Just to go a little bit deeper, a pre-qualification for people who might not understand all the lender lingo, a pre-qualification, we can give that out after talking with someone on the phone for about 30 minutes. A pre-approval letter, once we get your application and look at some of your documentation, we can get a better idea, dial the numbers in a little bit better, pull your credit, and give you a pre-approval letter. That's kind of like the industry standard. What we do is we go one step further and do give you a full approval. And, you know, when you get an offer, typically this step happens when you get your offer accepted on a property. So you've already walked through, you've already fallen in love with the property, you're already deciding what paint colors to paint the walls and where your furniture is going to go and all that kind of stuff. The last thing you want to have happen is for something to happen during the underwriting phase where your property falls out of escrow and the financing doesn't work. So we do all of that on the front end to make sure you're not going to have that headache or that stress of kind of questioning, you know, is it going to make it through?
Yeah, that's awesome. Well, out of the respect of everyone's lunchtime, does anybody have any questions or want to throw anything out there? Don't be shy.
Thank you. Oh, go ahead, Steve.
Yeah,
go ahead.
I would just say, just listening to you and Adri kind of rattle off the market data on specific cities and stuff that's sold. And if you're a buyer in the area looking to purchase a home, you need someone on your team who's going to do that research and know the data, know the differences between Glendora and Laverne. Like, that's crazy. They're neighboring cities and it's a different market. And so you can't just assume everything in the San Gabriel Valley is going to be, you know, is in the same market. So to have someone on your team looking out for you who cares about you, but is also competent and knows that market data to help you make a good decision for your family, I think that's a huge advantage. So good work.
Thanks.
Yeah, I echo that, because it's so important to have not just one person on your team, but several. When you have, when a buyer is fortunate enough to have the money to buy or the resources to buy, I believe they have a responsibility to do the right thing with what was given to them or what they've worked hard to earn. And so to have a lender that's on their side providing that wisdom and guidance, as well as Sarah and her team providing wisdom and guidance as far as the real estate goes, when you put them together, you're just in a winning position. And why wouldn't you want to do this? And then we add
you, Marilyn, in for our insurance. And then we're like, we're a killer team. I love it.
Right. But killer in a good way.
Yeah, right. What were you going to say, Adri?
Oh, I was just going to say,
thank you for that, Marilyn.
Yes, and thank you, Stephen, too. And to piggyback off what they were saying, if you are someone who's moving out of state or know someone who's moving out of state, these things that Stephen said, that we look at all the market stats, we dive in, we go in deep in each city, because it's not cookie cutter right now. And this market has changed a lot in the past 9 months. So if you know anyone or you are someone who's moving out of state, let us find an agent. We can interview them out of state in the area that you're moving to. And and interview them, make sure that they are someone who is going to look at those same things as us and have this, have lender partners that are helpful and, we'll do the things that Churchill does for our clients.
I was just talking with someone yesterday, someone who's never bought a house before, and you could tell they were a little nervous and a little scared. So I asked, what are you nervous about? What are you scared about? And they just said, I don't know where to start in the process. And so I think that's kind of a question that a lot of people have is, where do I start? And I think my answer is, you start with someone who you trust. So if you're close with, Sarah or Adri or someone like that, that's where you start. And then if you're close with someone on the financing side, that's where you start. Or if you don't have that resource, find someone who's bought a house and ask them, did you have a great experience? Who can you refer me to help me? And we can definitely be a resource to be able to help you kind of get on that path.
That's great.
Well said.
Well, thank you everyone for joining. I will be emailing this out to everybody. That way, if you missed any notes, you can go back and watch it. Feel free to share this video with someone you feel might bring value to. And we'll be scheduling our next Lunch and Learn at some point. Don't be shy to let us know if there's a topic you want us to hit on. But with everything else, thank you for your time. I just learned last Friday, I was at a mastermind and this gal just said, we should always thank people for their time because time is precious. And I thought, I don't do that enough. So I just want to say thank you to everybody on this call for your time today. It was just wonderful to spend our lunch together. So blessings and have a great day.
Thank you, Sarah and Adri. Thank you.
Thanks, Churchill.
Thank you.
Bye.